I read the book many, many years ago, and so I'm listening to it again right now. And that's one of his things is, just go for the big deals. If you're doing a deal, you just kind of price that interest expense or those points or whatever. It's just another expense. Your drywall, your plumbing, your electrical, calculate it all into your deal. If it works, it works. There's a myth out there that, hey, if I find a good deal, the money's just gonna. You are in this room and you're looking to make a difference and you're looking to build your company, get this skill set.
What's going on, guys? We've got another episode for you coming today with Tom Dunkel. He is the managing principal of Eagle Capital Investments. He's an 8 handicap golfer, a rock band frontman, and just all around serial entrepreneur. So we're super excited to have you on. Thanks so much for taking the time. Tom, if you want to just jump right in and tell, for those that don't really know you, who you are, what you do, all the things. So give us the background of Tom Dunkel.
Yeah, thanks, Jesse and Graham. It's great being with you guys. Looking forward to our time today. Yeah, so managing principal of Eagle Capital Investments, something I just started recently. But, going back to, I guess, getting out of business school, I finished up business school, was great. Had a great education in finance, economics, taxes, accounting, all that stuff. So I've, really started out from a, financial training aspect and ended up doing mergers and acquisitions in the aerospace industry, where I used all those tools to, build financial models and build projections and read financial statements and, structure deals and all that stuff. So, these were, multi-million dollar deals. We were doing, $50 million, $120 million acquisitions and working with private equity firms, putting bank syndications together for the debt piece and all this stuff. So had a great early training ground in doing deals and structuring deals. And so worked with some amazing people, Harvard MBAs, Wharton MBAs, ex-fighter pilots, astronauts. I mean, it's crazy. So it was really a great, kind of a foundational, ground for me to just get started. And then, fast forward a bunch of years, I kept doing deals, kept making other people a lot of money and always had a mindset of like, hey, one of these days I'm going to go out and do my own thing and do my own deal so I can make myself some money. And so I got the opportunity in 2006 when I was fired from my corporate finance job at a publicly traded company. The good news was as a VP at a public company, I had like an options package and things like that. So I was able to exercise those and walk away with a little bit of a war chest to go build my real estate empire. But like I said, guys, it was 2006. So I basically walked into like, a towering inferno. Those next few years, I was trying to learn real estate. I was trying to learn how to run a business, learn how to build a team, learn how to be a leader and all this stuff, which, I thought my background was going to be, it was going to be easy, right? Because I'd already had a good bit of success in the corporate world. And, but, I got my butt whooped pretty good those next few years and, found myself, just lighting all that cash I had saved on fire. And, but it was around about that time, 2009, I started learning about distressed mortgage debt. And, it was something that really resonated with me with my finance background, but also an interest in real estate. So I, kind of dug into that a little bit. I started buying some distressed mortgages. I connected with my partner, Joe Downs, at that time. And then, fast forward 15 years here to 2025, we've been in business all that time in the distressed debt industry. We've done over $63 million of revenue in that business. And, we've really built that company up. It certainly wasn't a straight line. We definitely had some big ups and downs. But the success from that business has allowed us to dabble and do some other things. So we have a short-term rental portfolio up in the Pocono Mountains of Pennsylvania. We tried to do hard money lending. That didn't really work out. We tried to do a title company. That didn't really work out. But then we found self-storage around 2018. We started digging into it. 2019, we put a team together and a business plan together, got some financing lined up. 2020, we bought our first facility in self-storage. And we've since acquired 19 facilities for going on $60 million across about 7-8 states. So right now we've got the distressed mortgage debt business, we've got the short-term rental business, and we've got the the self-storage business. And so I'll pause there if you want.
Yeah, lots to break down there.
You want to break anything down? Yeah.
So you jumped right out of college, jumped right into being putting all these deals together with combining all these aerospace companies, which is like crazy interesting.
Yeah.
I work a lot with like my glove company with a lot of aerospace and like companies and stuff like that.
Mm-hmm.
And so I'm fascinated by that world. How did you kind of get into that? Because that's like super specific.
Yeah, well, like a lot of things in life, right? You just sort of find these opportunities and you kind of stumble into them. So, actually, my first job out of business school was at Ernst & Young, which is one of the big accounting firms. I was on the consulting side. I just didn't like it. It wasn't a good fit, and so I started looking around for a job, and I found this ad for a senior financial analyst, and I went for a couple interviews, and next thing I know, I got the job, and it was amazing. It was a really great fit. In fact, it was hard to leave, but when I did leave the company, we had acquired 8 or so companies in the time I was there. We did over $1 billion worth of transactions. And then the CEO, super smart guy, he was like, all right, well, now it's time to integrate these companies so they work together and so they can kind of continue to grow, but they were looking to grow internally. And I was like, I've got the deal bug. So I'm kind of at the top of my game at that time. I'm like, I had a lot of great stuff to talk about in interviews and such. So I jumped ship at that time, which was hard, but it ended up being the right decision.
Financial guru, just kidding. The financial headmaster. And then you jumped kind of like by force into the real estate world. So talk about those first couple of years of surviving, finding mortgage debt, and then talk about, so before I forget, we actually had Joe Downs on the podcast, and he was amazing. We really enjoyed that podcast. So talk about those that jumping into the commercial real estate and all that stuff a little bit further.
Sure. Yeah. So, it was getting fired was, a real blessing in disguise because it was really the kick in the pants that I needed to actually go out and do my own thing. So, I had a young family at home. I had a wife and a 4-year-old and a 2-year-old. So it was a little scary, but like I said, I was able to walk out with a decent chunk of change, and my wife was working too. So, we had a little bit of a safety net there, but yeah, when the market started shifting, well, and just to back up a little bit. So I started out doing wholesaling, which is for people who don't know what that is, you're buying a house for cheap, and then you're marking it up a little bit and selling it to an investor that's going to rehab it and sell it or whatever, and you're making a little bit of a spread in there, your wholesale fee. So that business requires a ton of marketing, right? Because you're having to either do direct mail or even billboards or radio, or you're having to advertise a lot, and so you got a pretty high monthly spend. So I'm having to spend this money to get these leads, and then the market's sort of working against me because things were the financial markets had kind of seized up, and deals weren't getting funded, and real estate prices started falling and all that stuff. So and I was trying to put a team together, which, like I said, it was kind of my first time doing that. So of course I totally screwed it up. I didn't hire the right people. I did have one good hire. She helped out a lot. She was a really good sort of administrator and whatnot, but it doesn't take too many bad hires to really tank your company. So I ended up having to fire everybody. I had an office space that I was kind of stuck with. I had to kind of negotiate my way out of that. I had all kinds of stuff going on at that time, which didn't feel very good. But I was determined. I was like, I'm not going back to corporate America. Determined to kind of stick it out and just make something happen.
I think when you're first jumping into real estate or commercial real estate, the first few years are really tough. And so you got to figure out a way to survive. And it sounds like you had the grit, was needed to, push through that. It's a tough thing to accomplish. Talking about the bad hires and how fast they can put you back, I think the right hires can push you and excel you way faster. So talk to us about what a good hire looks like then.
Totally. Yeah. So we've, subsequently, kind of learned and have been able to make some really good hires. course. I have to say, to be perfectly honest, a lot of it it's a little bit of a crapshoot, but I do believe in kind of the slow to hire, quick to fire mantra that some people use out there. So in other words, take your time to get to know someone, make sure they're interviewing with a lot of people on your team. It's not just interviewing with you and then you hire them. You want to get different perspectives from different people at different levels in the organization. And it might sound a little weird, but I think you also want to interview the person in different locations. So you want to do one in the office, maybe go out, do one over lunch, or, do one, somewhere else. And, cause that, those different environments might, just help you peel back the onion a little bit and get to know that person a little bit better. But, the resume is that's just the ante, right? To get the interview. So, presumably when you're interviewing someone, they already have the skill set that you're looking for, or you feel like they have the aptitude to pick up the skills that you need for the position. So ultimately, when you're interviewing, it's more about the fit, right? It's more about the culture. It's more about the personality and that sort of thing. And so, you want to make sure you're asking a lot of questions. I know some interviewers, they just start yapping, kind of like I'm doing right now. And, it's not the best way to get to know someone or get to learn about them. You want to ask, some open-ended questions. And I like to ask questions too that might make them squirm a little bit, like, tell me about a time that when you failed and how did you handle that and what was your attitude like and how did you treat the people around you and because it never gets better than the interview, in a lot of cases. So you want to make sure that you're probing and if you do bring them on board, God willing they work out, but if they don't work out, you're probably going to know pretty quick, and it's better to just let them go early and because otherwise they can just linger on and you're paying them and you're not getting the value in return. And in a worst case scenario, they might even become kind of cancerous and sort of poison the team a little bit. And so you definitely don't want that.
Yeah.
Something I've seen and learned over the last little bit, I'm sure you probably heard of the book Traction, but they talk about like the biggest things is like setting a vision for the company and then also the core values. So like, if you do the US model and you're doing Traction, that you have to set out a 1-year goal, then you set out a 3-year goal, then 10-year goal, and you also do breaking into quarterly goals. And then prior to that, you're setting up your company values. And you mentioned that, obviously a huge part of hiring people is that they fit within the culture of the company. I think that's so true. And right. We're fortunate to work at a company that is that's something they do extremely well. Their company culture is awesome. It's like all about growing and, self-improvement and being super passionate about real estate. And they ingrain that into people. And I've literally seen it attract people who fit that mold. And so then it creates this really cool company culture. Whereas if you have kind of like a weak culture or, maybe just a mission statement or something, you're not very clear on that vision, then, you're going to get mediocre results. So I think that's huge. You mentioned something earlier. You said you kind of got started in real estate through wholesaling. I'm curious, did you ever do any commercial wholesaling?
You know what? We did a little bit of commercial wholesaling when we got into the self-storage world. We did assign some contracts. And we're actually looking at expanding on that. As a more defined and deliberate kind of business function within our storage company, Belrose Storage Group.
Yeah, I think it's great. I haven't personally done it yet. I want to though, and I've seen people do it. And a good friend of mine who's very successful young guy, he kind of got started in commercial real estate because he went from a residential wholesaler to a commercial wholesaler. And he kind of almost did it by the commercial part almost by accident. And then he realized, oh, this is crazy. And I just was talking with him a week or two ago, and I was talking to him about this little deal because we're brokers. We do commercial brokerage as like our day job. And it's a $450,000 deal. And on $450,000, 3% is what? Let's see, 0.03, $13,500. He's telling me, he's like, have you ever just considered tying it up at like, let's say the building's $450 and you can get it for $400, just flipping it to somebody for like $450, because he literally just did that and he made $50,000 on a deal that where, if you're brokering, you make $13,000. So I think it's great. That's kind of a side tangent, but the point is for the people listening who are just starting out in real estate and commercial real estate, you can get into wholesaling or commercial wholesaling. And just like he did, he made $50,000 on a very
Yeah.
small deal. In commercial real estate, $450,000 is very small. To us,
Yep.
it's still, scary and intimidating, but 450 is very small in commercial real estate. So if you
That's
can
right.
get in and make 50 grand, that's probably going to change your ability to go out and your confidence to go out and find these deals.
100%. And you guys, I think, would agree, doing a $45,000 deal takes just as much time as doing a $450,000 deal. It's funny. I'm a big Donald Trump fan, so if you don't like that, fine. But I am listening to the Art of the Deal again. I read the book many, many years ago, and so I'm listening to it again right now. And that's one of his things is, just go for the big deals. Like he was just talking about a deal that he did with his father back in the 80s. They bought an apartment building. It was like 1,200 units, but it was only like 40% occupied or something. So he's just kind of telling the story about that. And he's like, it takes just as much effort to run a 1,200 unit apartment as it does a 50 unit apartment. And the truth is, it's probably easier to get a 1,200 unit deal financed, right, than a smaller deal. And on a 1,200 unit deal, like a wholesaler, if someone wholesaled that deal, they could make a $500,000 wholesale fee. There's a couple friends of mine in our self-storage mastermind group. They made $1 million wholesale fee on a deal a couple years ago. Because when you're dealing, when you're wrapping something up, you're tying up a property for $8 million and you sell it for $9 million,
Yeah, that's $1 million right there.
You can make a pretty nice pop there with not a lot of risk. There's definitely some work up front. You got to dot your I's and cross your T's, but in the end, it's really just hustle. And you don't need a big staff. You don't need a lot of overhead. You just need to be a hustler and go find a deal and get it done.
Yeah, for sure. And wholesaling, for people who don't know, I'm sure most of you do, but basically you just put the property under contract in your name or a company name that you have, and then you assign the contract to another party. And in exchange for assigning the contract to the other party, you get a fee, whatever it is. So the better a deal you can negotiate, the more of a fee you can make, because you still have to leave some meat on the bone. I mean, maybe you could sell to a retail investor, that's true, but most of the time if you're dealing investments, you got to leave some meat on the bone. So you have to get a really good deal, but it's very possible. I see a lot of people do it. And I know you'll agree with this too. There's a caveat to what he said. If you're going to go for the big deals, just make sure that you are partnering with someone who knows what they're doing if you're brand new and not experienced. If you're brand new and not experienced, even on a small deal, you should still partner with people.
Grant, that's a great point. In fact, one of my mentors from a long time ago, who is an extremely successful commercial real estate developer, he said, on your first deal or two, just give it away. And what he meant by that was get a deal, partner with someone that knows what they're doing, or otherwise just make sure you're in the game, getting the experience, because the experience is what's going to allow you to then build a business on top of that. So forget about the money aspect on your first deal or two. Get the right partners in place, get the experience, so that then you set yourself up for success in the future.
100%. And that's, we were fortunate to basically do that. The first deal we did, commercial building, was very small. It's $250,000. We did it with a close family friend. They put up $60,000 for the deal. And we literally said, this is going to be our experience. You get 50% of the equity. You get 100% of the cash flow. We'll do everything on the deal and keep, 50% of equity, but we'll do everything for you, get all the cash flow and everything like that.
Nice.
And that way it's going to build our track record.
Yep.
So we did that. And then we bought another deal with a company we work with. It was four buildings actually around the corner. We got a little bit of equity there. And then I 1031 to personal house I had and bought a warehouse as our third deal. And so we did three deals in a pretty short period of time. We were extremely fortunate, but the point of that is not to sound arrogant or anything. The point of that is to show that it is very important in the beginning to build your track record, because now we're under contract on our fourth, and we basically, it was kind of, me and Jesse were kind of like shocked. We were sitting here talking about all this stuff. We're like, man, we're extremely fortunate to be able to do all this stuff in a short period of time. And we're getting hard money for the fourth deal. And so we presented these things like, this deal we just did in this area. We know the rents. We did this all because we have that experience. And the person was like, okay, that sounds good. Like, I trust you guys. And we got off the phone. Jess was like, man, you just walked through that like it was nothing, because we just did all of it so quickly.
Right.
But the point is, like, you just get experience by doing. And did we run those things perfectly? Absolutely not. We made a lot of mistakes. We learned from those mistakes, and hopefully we're going to continue to improve and get better. But like you said, building a track record is extremely important, especially in the beginning.
And now you're in the game, right? You're not like on the sidelines. You're in the game. And when you're in the game, cool things can start happening. You put yourself in the way of opportunities, and then
100%.
things start to come your way. And yeah, so it's important to just get in there for sure.
100%. We got offer like about maybe 3 weeks ago, a month ago on the two buildings we bought. Great offer, substantially more than what we paid for them. So like you said, you put yourself in. If you get into the game, then you can have opportunities. A guy who's the leader of the group we're in called Commercial Academy, Scott Scheel, he's like, I can't remember the exact quote, but he basically says like, I promise you'll get like way more lucky if you're in the commercial real estate game than if you're not. Like it's not necessarily a matter of if, it's a matter of when one of these crazy things is going to happen to you if you're in the game. That's right. Like exactly what you said.
100%. Yeah, you create your own luck.
For sure.
Like, oh man, that guy's lucky. Well, you got to look, like our stressed debt business. It was like we were 8-year overnight success story.
Yep.
It took us 8 years of battling and clawing and scraping and kicking. And then finally, 8 years later, we had this huge deal that we did. We made a ton of money. And then that just sort of took us to the next level. And then recently we did another deal that then took us to another level. So it's, but none of it would have happened if we wouldn't have bought the original 6 loans that Joe and I bought. We bought 6 loans for $12,000. That was our first deal. And then the last deal we did, we bought like 2,500 loans for, a couple $1 million. So it's like, you don't get there without starting there.
Yeah, 100%. You got to start somewhere. I'm curious with your, super diverse and unique background. You've had a lot of experience, and I saw that you mentioned you'd been on like 90 plus podcasts. What's your reason behind getting on podcasts, getting your name out there, and why do you think it's important?
Sure. Yeah. Well, we talked a little bit about, my background, corporate background, and my companies and stuff, and then Belrose. So my new company is Eagle Capital Investments. And so what we found over the years, when I was chief investment officer at Belrose Storage Group, I was in charge of raising all the capital. And so we put that system in place. And then I transitioned out of Belrose Storage Group last year. So I could start Eagle Capital Investments, which I'm just using the same skill set, just instead of investing just in storage, we're investing in other asset classes as well. So I've had the good fortune of being able to build a nice following of investors. And so, but I'm always looking to build more on that. And so that's why I do the podcasts. I write some articles, do some other things. So it's basically just, kind of getting out there and letting people know about Eagle Capital Investments, about me and my background. And so, so I'm looking to build our list of investors that can join me, because I invest in every one of the deals that we do in Eagle Capital Investments. Even though I've done a ton in storage and other stuff, I've actually been a passive investor, an LP investor in multifamily since 2013, so 12 years now. So, and I'm also looking at other asset classes, because along my journey, right, I've met amazing operators in different asset classes. So, I've got a couple multifamily guys that are just awesome. I've became friendly with them first before I actually invested with them. And I have a mobile home park guy that I really, really like, just looking for the right timing and the right deal to do with him. I'm also a big fan these days because, there's a lot of volatility right now, a lot of uncertainty. Where are interest rates going? Are we going into a recession? Who knows? But recently I've shifted a lot of my personal investing attention to private lending, which again is something I've probably been doing for over 10 years as well, where I just lend to either, guys buying a commercial building or a residential property, looking to fix it up and sell it. And so it's typically like a 1-year note. I get interest payments every month at a high interest rate, and I'm secured in first position by the property. So it's a great, to me, it's a great cash flow, risk adjusted kind of investment especially for this time in the real estate cycle. But yeah, I'm out there just looking to get it in front of investors that might want to tag along with me to invest in these kinds of opportunities.
So there's a lot of things I want to ask you there, but for my first question is, would you ever consider a second position note?
Possibly. I'd have to look at the look at the deal.
We may have to revisit that later.
Yeah, that's what I was going to say. That's what I was going to say. We're going to add you to our list here, because we don't know many, but like I said, we're doing our first one with hard money right now. So, and then the person who's lending the hard money is doing second position. So
full transparency, our distressed mortgage debt business is called U.S. Mortgage Resolution, and we've primarily been buying pools of distressed second mortgages. So I know fully well like what a second mortgage is all about and what you can can and cannot do and that sort of thing. So I'm not opposed to it. It's just a different risk profile.
What do you, you don't have to maybe disclose exact things if you don't want to, but like what's rough terms? Like if somebody wants to go out and do what we're doing now with the hard money loan, what can someone expect the term to be, the timeline, all that stuff?
So for the rehab loans that I've been doing, they are typically at 12% and maybe a point or two. It varies deal to deal, but that's generally where I fall out. And it's a 1-year deal, it's a 1-year term. First position mortgage, recorded with the county. So everything's recorded and legally buttoned up, and I've got all the documentation. My attorney puts together, I don't know, it's probably 100 pages of documents for the promissory note and the security agreement and the mortgage and the assignment of rents. And anyway, so we get it all documented properly, so we can be feel safe and secure as a first position lender. But that's generally where we're at. And then if there needs to be an extension, it might be a couple points to extend the loan. But the reason that this type of loan is even possible, like some people might be out there like, why would someone pay 12% or 14% for a loan? It's like, well, because if depending on where I'm at cash flow wise, cash position wise, I could wire you $250,000 tomorrow, so you can get that deal and you can be a cash buyer out there, and you can close quickly. So you can outperform some of the higher offers that might need, bank financing or get it, they might need a longer time. So that's kind of the attraction. And if you're doing a deal, you just kind of price that interest expense or those points or whatever. It's just another expense, your drywall, your plumbing, your electrical, your interest expense, you just calculate it all into your deal. If it works, it works. It's a win-win all the way around.
Yeah. It's the cost of doing business.
Exactly.
Just like you said, it's the point of what we were talking about earlier, get in the game. So if you got to get hard money, with speed, there's some sellers who you might come across and you're like, well, in commercial real estate, the timeline's typically like a relatively fast timeline's like 60 days, at least from what we see in brokerage. 90 is more common, and even like 120 sometimes. So if you could say, hey, listen, we like this property, it's a good enough value, you could say, well, we'll close in 30 days, like you said, or maybe 45. And to a seller maybe in a distressed position, they don't want to sit and wait around for 90 days or 120 days.
Sure.
They hear 30 days, they might take 20, 30, 40% off of their price because they want that money now instead of waiting, so like you said, it's a win-win. And for those listening, like you said, why would you do that? Why would you do the money? I'll give you a rough breakdown of what we're doing. So we're buying the building for $450. It's 10,000 square feet. We should be able to lease it for $6 conservatively because we did that already. $7 is more aggressive. I actually think we can achieve that if we can lease it for that in the amount of time we need, which will be about 6 months. I think we can do that for sure. We did the other 2 in 3 to 4 months. So, and there's an extension too. But anyways, let's say we lease it for $6 or even $7 a foot. Now with the value, because of commercial real estate's valued on the income, it will be worth $750,000 to $800,000, which means we can then go take that to the regular bank, refinance. They'll give us a loan for we're underwriting will be all in for $500,000, so $450,000 plus our $50,000 in capex, all that stuff, carrying costs. So now we just got to get a loan for 75 to 80% of that, so we can go pay off our seller finance note, our hard money note, and create a couple $100,000 of value, and still own the building. 100% me and Jesse versus bringing on an investor where you're giving away 50% or whatever it may be.
It's with little to no money out of pocket as well.
Yeah, with little to no money out of pocket. So if you can do it, which we're about to find out, we hope we can, we think we can, it's going to be a game changer for us.
Sure. Yeah. And Graham, you just hit on one of the huge differences between commercial real estate and residential real estate, right? So in residential real estate, I have a guy who I do some lending to. He's got a great business model. He rents out houses by the room, so it's really good, kind of a low income play type thing. And his houses cash flow like crazy. But the problem is when he goes to refinance on a residential property, he can't get the appraiser to include the income. They only look at the comparable sales of that similar type property, a 3 or 4 bedroom, row home in Philadelphia. Whereas, so he's making this tremendous cash flow, which is great, and I love it as a lender, but he's not really getting the value that he really should. If he could do the same kind of thing in a commercial building, then yeah, he could absolutely increase the value of the property and get paid like you guys are looking to do, which is awesome. Wish you guys all the best with that deal. But that's a huge difference, and I think it's a real game changer, like you said, about getting into commercial real estate, because you do get that multiplier effect where every dollar that you can increase the net operating income of a commercial property, you're getting a 10, 15, maybe even 20 times increase in the value of the property for every dollar you increase it. So it's that's the real
it's the secret
thing
sauce
that can blow your mind in commercial real estate. Like early on, with our storage business, we had a couple early wins where we bought it's been a little while, so forgive me on the numbers, but it was like we had a $200,000 NOI that we bought, and we increased it to like a $300,000 net operating income over a year or so, and we were able to sell the property for like twice as much as we bought it for, and make our investors a huge return and everything because of that cap rate type of compression, cap rate type of environment that you live in when you're in commercial real estate versus residential.
Mm-hmm. Yeah, it's the secret sauce for sure.
Yeah. So going back to you going and starting Eagle Capital Investments, what it sounded kind of like was you started focusing on storage first. You really learned that, and then you wanted to expand after that. And you were kind of doing it along the way by LPing and other deals. I think that's a great point for people out there that do have money that want to place it into investment now, but don't exactly know how to do it. Partner up with a good GP, and then they can kind of show you the ropes throughout the deal while you're an LP in that deal. I think that's a good kind of tidbit that we kind of missed there. But I wanted to make sure that's exactly what kind of like how your story went. And then two, what other assets are you going after?
Sure. Yeah. Well, it's funny. I talk about a lot of this, Jesse, in a book I just wrote called The Wealth Builders Playbook, which is really about, there's a lot of aspects to the book. So I invite people to go grab it. But it's, one of the things is partnering up with, like you were just saying, with a great operator, a great GP, because they can make your life so much easier, instead of, managing a deal yourself. A lot of people came to us when we were building our self-storage company, and they would say, oh, I just want to buy my own self-storage facility. And we said, oh, well, that's great. But, this is what we do. Have you thought about this? Have you thought about that? This management platform and dealing with, vacancies and dealing with delinquencies and blah, 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 blah. And then they're like, oh, geez, well, I don't really want to do all that. So, okay, I'll just invest with you guys. But yeah, if you're finding someone who's a real quality operator in their particular asset class, then you can be a passive investor. You can make your nice cash flow. You can make your appreciation. You can get your depreciation on your taxes. So you get a nice little tax benefit there. And then, someday you'll get a phone call and they'll say, hey, we're getting ready to sell the company or sell the property. And, you're going to make a whatever, 15, 20, 25% return. And meanwhile, you were at the golf course or the beach the whole time. So that's kind of where I'm at, to be honest. Like I'm trying to work a little less, but spend a little more time on my golf game and such. So that's honestly, why I'm building Eagle Capital Investments, is because I'm an investor at the end of the day, right? I've invested in all these different asset classes over the years. I've gotten to know some great operators through the mastermind groups and the networking groups and all these things that I've been to, the conferences I've gone to. And so I'm just looking for deals for myself. And I figure, hey, if maybe someone, maybe the list of investors that I've got, or maybe new investors out there would want to take advantage of my 19 years of experience as a real estate entrepreneur, or my 30 years of experience as a finance and investment guy, and say, hey, you know what, instead of going out and banging around, going to the conferences and meeting the people and doing the due diligence and running the numbers, I'll just trust Tom. If he's putting $100,000 into a deal, I'll put in $100,000 too. And so if I can find, 10 or 20 guys to do that along with me, then we can go to an operator. This is where the special sauce is. We can go to an operator with that $1 million or $2 million and say, hey, we know you're doing this syndication to buy this multifamily property. I know your minimum is $50,000. You're looking at raising 50 or 100 grand from all these people. If I come to you with $1 million or $2 million, will you give me better economics? And the people that I work with are absolutely thrilled to do that, because if they can get one check for a couple $1 million, then it just saves them a lot of time and aggravation in terms of going out and herding all the cats at 50 and 100 grand. So as an example, instead of me writing a check for 50 grand and getting 7 pref and like a 70-30 split on a multifamily deal or an industrial deal or a self-storage deal, if I can bring that whole bigger check, I might get an 8% pref and an 80-20 split. And so that would come back to me and my investors. So I'm able to pay my investors more than what they would get if they went directly to the operator. And I can also create a little bit of a spread in there for the good guy to make a couple bucks for putting the deal together. So that's kind of the Eagle Capital business model. I don't do a ton of deals. I don't do a ton of marketing. I'm not looking to build some huge group of investors. I'm just looking for, like-minded people who, would appreciate my experience and my deal flow and, look to help them build wealth.
That's awesome. So essentially you collect capital from friends, family, connections you made over the years.
Mm-hmm.
You take that capital and use your expertise to go deploy it into good operators deals. In exchange for doing that, you make a little bit of spread in between. And I assume you probably get a little bit of the equity of the deal as well.
That's right. And that's exactly right, Graham. But I guess I would just add to that the operators are people who I have gotten to know, like, and trust over the years too. These aren't new relationships. And I'm putting in my money too. So it's not, I'm not asking someone to do something that I'm not doing myself.
Yeah. It's a perfect example of who and not how.
Right. Exactly.
Literally. You're going and you found who's the operator, and so instead of going out and doing all this work myself, like I used to, because you earn that anyways, with your track record, then you're saying, I've had my battle scars. I've done all these deals. I have the expertise. Now I can use the capital that I've earned and go deploy with these people. And it's people who I trust. And now I don't have to worry about how I'm going to do it. It's just who's going to do it for me. That's right.
And that's right. And I talk about in my book about how, high achievers, a lot of times they have difficulty kind of giving up that control or taking that step of that trust. But it ends up holding them back from building their wealth because they can't do everything themselves. They need to be able to focus on what it is that made them a high achiever, and let me, as their who, help them build their alternative asset portfolio so they can build wealth and not have all their wealth concentrated just in their business.
So earlier you talked about how you raised all this money for business buying, joint venture stuff. You said that it didn't translate to real estate. I'm curious as to why, because we're talking about, you're raising debt now. I'm just kind of curious the differences.
I would say that, the financial deal structuring stuff primarily it translated fairly well.
Mm-hmm.
I think what I didn't learn in my corporate life was really just kind of the running the business side of things, building a team, kind of the management and that sort of thing. But there are definitely differences in the M&A world type financing versus the real estate. Generally they're pretty similar, but in when you're buying companies, when you're putting big deals together to buy companies, the lender. So like I have I'll show you this. So this is a deal I did way back when, $140 million revolving credit and term loan facility. See all these banks listed here?
Yeah.
These are all banks. So when you do a big debt deal like that, it doesn't go to just one lender doesn't do it. So you've heard of syndications probably on the equity side. When you do bigger debt deals, the banks actually syndicate. So there'll be like a lead bank and they'll get paid more than the other banks. And then, so this one was, a lot of these banks probably don't exist anymore, but Deutsche Bank, Manufacturers and Traders, Mellon Bank, and Nations Bank. So, and it was all put together by First Chicago Capital Market. So anyway, so you're not seeing that typically in a multifamily acquisition deal. And, those are probably, Fannie Mae is guaranteeing it or something. And so it's really just one lender. So there's a little less complexity because there's a little fewer zeros.
Yeah. Well, I think there's a lot of parallels there though, because now you're the lead bank and you're pulling in other banks, right? You're pulling other people that have money to buy these deals with good operators,
right?
And to kind of bring that down to even closer to earth, me and Graham are the lead bank, if you will. We went and borrowed money from a close family member, bought the deal, gave them all the stuff to prove the record. So that just shows it's, like you said earlier, it's easy. It's the same work to buy 1,200 units than it is to buy 50 units, to buy 4 units. It's the same work. So
that's right.
It's a good reminder. It's a good reminder.
That's right. Yep. And whatever you do, like, there's a myth out there that, hey, if I find a good deal, the money's just going to magically show up.
Yeah.
That is not true. That was one thing that we were very deliberate about at Belrose Storage Group when I was raising the capital there as the chief investment officer. We specifically made capital raising like its own silo within our business that I was in charge of. So I had a team underneath me, and all we did all day, every day was raise capital. So whether we had a deal or not, we were out there marketing. I was doing podcasts. We're posting on social media. We're trying to, generate that activity. We're trying to add value to investors out there that might want to learn about self-storage or what have you. So you should always be out there looking for money, looking for investors. If you don't have a deal, talk about a deal that you did, or talk about a deal that you're looking at. Talk about a deal that you passed on. Investors love to hear that you're not just buying everything that you can get your hands on, right? They want to hear about the deals that you passed on. They want to hear about deals that maybe didn't go well. And so, you want to constantly be out there raising capital. There's a lot of people out there, they wait till they get a deal and then they try to go raise the capital. And if you're trying to raise a lot of money, you might find yourself losing that deal because the money might not show up, and so it's something that if you're serious about building a real estate business, you've got to make capital raising you have to put someone in charge of that like full time.
Yeah. Good. As you mentioned, you got to have your hands and you got to keep all the cogs of the business going at one time, because you got to be funding more deals. You got to be making sure you have money. You got to make sure your current portfolio is still managing. And if you have someone over each of those branches, then it's just going to make everything run so much faster. And it'd be hard to do with, even still if it's just one or two people. So you just got to find the right who's.
That's right. And as you're so the two of you guys, right, you probably have things divvied up. And so as your business grows, you need to be looking at replacing yourselves in those certain boxes. So that's another thing, Graham, you mentioned traction, and you talk about the accountability chart in there, which we have at Belrose Storage Group. And that was, we had all the different areas of accountability in there. And yes, in the beginning, you're in all the boxes as the owner, or maybe, you and your partner or whatever, but what you need to do over time is find people to, replace you in those boxes, so that then that gives you the opportunity to grow and scale and do some cool stuff.
Yeah, we're big on like buy back your time. We haven't really started implementing yet, but we want to. We're still kind of in the early stages. So I'm sure you're familiar with Dan Martell.
Yeah, got his book right here.
Oh, sweet. We're fun fact. We have another podcast today at 2:00 with his social media guy.
Okay,
so
cool.
The guy he hired to take him, I think he started with like 80,000 or 100,000 followers. He took him from that to over 1 million followers. So
nice.
It'll be a good interview. But anyways, the point of what I'm asking is, are you, like for us or anybody, who's just starting out, like you said, in the beginning, you're doing everything, all the boxes. That's you. So first step, do you think it should be executive assistant like it says in the book? Is that what you recommend with your experience, because you've been in so many different businesses and stuff?
Yeah, I do. I mean, the idea is to give you the bandwidth to focus on the highest payoff activities, right? So the bookkeeping and the administrative side of things, that's all, no offense to those people who do a good job doing that. I mean, we have a very experienced, very valuable person on our team, but that's her job, is administration. And by the way, she gets paid pretty well. So at this stage, but you want to delegate out those positions that are $100 or less per hour, so that you can focus on making $1,000 an hour or $5,000 an hour, or whatever it is. So yeah, I think administration and bookkeeping are two early hires that I would tell people to make for sure.
Awesome.
Gotcha.
Awesome. And do you have that in house, or do you do like virtual assistants, or both?
So we have our administrators in house. She's been with us a long time. Accounting and bookkeeping is interesting. Like, we started out years ago, we started out with someone in-house, and then we started to grow, and then we took it and outsourced it. And then we weren't really happy with it, so we brought it back in the house. And so now we have kind of a hybrid model. So we do have an in-house accountant, but she's like a traffic cop who manages our outsourced accounting and bookkeeping firm, and she also is the traffic cop that manages our tax preparation relationship.
Gotcha.
That makes sense. Yeah. So one of the last things I wanted to kind of touch on with you is you have, that you're real big about giving back. So talk to us about kind of how you do that and how other people should be doing that as well.
Yeah, sure. It was years ago. Years ago, I was at a real estate investor meetup of some kind. There was some national speaker that came in. To be honest, I don't even remember what his name was, but I do remember one thing he said that just stuck in my mind to this day. He says something about, if you are in this room and you're looking to make a difference and you're looking to build your company, and create these, get this skill set so that you can go out and build wealth, then your job really is to build that wealth and give it away, because now you have the skills where you can go and you can build more wealth. You can do it again, right? And so when he was talking about that, I was like, wow, that is not something I'd ever heard before. Build all this wealth and then give it away and then go build it again. So, so I probably forgot about that, because like I said, it was years and years and years ago. And then, a handful of years ago, I found myself in a position where I was able, I had the wherewithal to, start doing some things. And so it just was something I felt compelled to do because I had been able to build some wealth. And so the ways I've been giving back are a handful, I guess a few different ways. One is sort of hands-on. So I've done some mission work. I went and built houses in Mexico. So that was pretty cool. Getting up on top of, I'm scared of heights, but I was up on top of a roof, like nailing in shingles on this house that we were building. So that was pretty crazy. We were down this very, very, very impoverished area of Mexico doing that. So that was kind of cool. That was very hands-on. I've also started to do some mentoring through there's a program in our area outside Philadelphia called the J. Wood Platt Caddy Scholarship Program. So these are young men and women who are caddies. They carry golf bags, in the summer and make a living, but they also have this caddy scholarship program. And as part of that, there's a mentorship aspect to it. So I signed up and I've been mentoring some of these young men who are in college, looking to, find out, what it's like in the real world, what direction should they head in, what skills should they be developing, that sort of thing, what goals should they be setting. So I've been doing that. That's more just, kind of a time and just sharing experience and such. And then, another big outlet for us is tunnels to towers. So I'm a patriot. I love our country. My son's in the Navy. You can see over my shoulder here. Jesse, I know you're in the Army. My family's been here for many, many, many centuries, and so we've fought to build this country. So I really appreciate the people who are fighting for our country, trying to keep us safe. First responders, all that stuff. So Tunnels to Towers is an organization that was started after 9/11. The founder, he lost his brother, was a fireman. Everyone's running away from the buildings. His brother went in, full fireman gear, climbing those stairs, and sadly never made it out. But there are service members out there who are out fighting and protecting our country. They're getting injured, they're losing limbs, they can't really live in a normal type of house. So Tunnels to Towers, one of the things they do is they build houses that are specifically designed for people with certain disabilities or challenges, so they can wheel their wheelchair into the shower kind of thing, and the countertops are a little lower, and all those kinds of things. So I've been giving to that organization for a while, and then now starting Eagle Capital Investments, we are now a corporate partner of Tunnels to Towers, and so every investor that invests with us at Eagle Capital Investments, we make a donation to Tunnels to Towers on their behalf. And then we also donate 10% of our profits every year to Tunnels to Towers. So we're really passionate about that organization and just, taking care of our super brave and amazing people out there who, I think it's easy to take them for granted, but they're really out there working hard for us, putting themselves at risk. Yeah. So I just want to show them a little love.
It is awesome. I appreciate you doing each and every one of those. When I was in college, I was a part of an entrepreneurship program. It was kind of shut down by COVID, but either way, we still did it virtually. And I think a lot of my entrepreneurial drive and kind of kickoff was through that. And so continue to do that because it was really helpful for me. So I appreciate you doing that.
Yeah. That's great.
Yeah, giving back is so important and awesome. So obviously, if you can do it anyway, I mean, I agree 100%. One of the guys we interviewed too, Brian Lubin, he talked about that a lot. He's like, it's your obligation it's like your moral obligation to make as much money as possible, because you can make as much money as possible and be a good guy and go out and do good with it. Or, you can let other people who are maybe not so good go out and make money and they're not going to really do much with it. So if you can go out and make an impact, that's the whole point. Like, what else? What's the point of what you're doing? So I think that's 100%. Awesome. So if people want to connect with you and find out more about you, what's the best place for them to do it?
Yeah, sure. Jesse Graham, this has been awesome, guys. Appreciate you guys. So I'm Tom Dunkel. I'm the managing principal at Eagle Capital Investments. You can find me at investwitheagle.com, and you can find my book there and learn a little bit more about me and my strategy, and join our inner circle of Eagle investors.
Awesome. Well, go check that out, guys. We appreciate you listening, and this has been another really good episode. I hope you enjoyed it. Thanks so much, and we'll see you in the next one.